Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard. John, what's coming up on the show today?
Jim, today we're going to do a brief review of how the KRO 2024 favorites collection has done, and then focus a bit on a new development that is affecting one of the favorites, Arizona Gold and Silver.
How has your 2024 favorites collection done as of the end of July?
During July, the 2024 KR Favorites Index tracked sideways after a fairly sharp decline in June, and it is now down 9.3%, which is better than the 19.3% that was down in February, but down from the rebound in May that took it up 10.5%. The bad news is that only two companies are up this year. Colonial Coal International Corp. Up 75.3% at 333, and Solitario Resources Corp. Up 51.3% at $1.13. I discussed Colonial Coal in a Kaiser Watch episode July 5th, and there isn't really much to add on that. However, what's interesting is that we are seeing rising price with rising volume, and that the company is now in the midst of entertaining various offers from potential buyers of Colonial Coal and its Huguenot and flatbed metallurgical coal assets in northeastern British Columbia. But everything's wrapped up in non-disclosure agreements, so we are not able to, like if I call Dave Austin, I can't find out anything about what's happening. But I think the market trend is telling us that the potential bidders are getting more serious, and Citibank is vetting the different offers, probably playing both sides of the table, and it'll be up to Colonial Coal to decide which offer to accept first. Our hope is that once an offer is accepted, it pushes the other bidders on the sideline into the market and engage in an auction process so that whatever the initial offer is, the eventual buyout price ends up being significantly higher. With regard to Solitario, I discussed it last week's Kaiser Watch episode, July 24th, and there really is nothing to add other than, be patient. They are drilling the downpour target at Golden Crest, and we probably won't hear anything until September at the earliest. So it's a good time to just forget about Solitario for now, or to accumulate it if you are finally happy that they are drilling after a couple years of delays getting the U.S. Forest Service to approve their plan of operations. The worst performers of the KRO 2024 favorites collection have been three lithium stocks. Brunswick Exploration down 75.3% at 20.5 cents. Patriot Battery Metals down 52.2% at 4.75, and Winsome Resources down 41% at 62. I'll look at these juniors and their prospects in greater detail in a future episode, but for now, let's say all the lithium stocks are still suffering from the optics of a declining lithium carbonate price, which is now at $5.18. It's broken through $6 a pound. It'll probably break through $5 a pound before it reverses. The sector is suffering because there is a slump in demand growth for electric vehicles. Consumers are balking at the limitations and affordability of the EVs offered by Western car makers. And while China has cheaper EVs that are good enough given the price, the United States and Europe have erected trade tariffs to block them from coming in. They are in essence protecting their domestic car sector. And what seems to be happening is that the car makers realize that what they have offered to the public just isn't going to result in runaway sales. They are in essence going back to the drawing board, which is kind of what Toyota did a number of years ago when it sat out the whole EV boom. The goal now is to come up with a solid-state lithium-ion battery that results in a car that is affordable and gets rid of the range and charge time anxiety that keeps ordinary consumers from wanting to buy an electric vehicle. There's also the problem now that although Elon Musk has decided to back Donald Trump himself thinks climate change is a hoax and has declared that he will do his best to reverse energy transition policies. And this has alienated the core fan base for Tesla. It's not clear that Trumpers are going to be rushing out to buy an electrical vehicle, which they see as an offense to their internal combustion engine cars. So that's not going to help things very much. But the reality is by 2030, we'll see the solid-state lithium-ion batteries in these cars. By 2028, we'll start seeing them enter the market. And for companies like my three lithium favorites, they are all about delivering supply in 2030. They are not producers who are being chiseled by CATL to long-term contracts at really lousy prices, and also by Tesla, which also loves the idea of lithium being super cheap. These are for the EV-related energy transition goals to become reality. We need a 6 to 12-fold expansion of supply by the 2030s. And so these pegmatite explorers, they are now looking to find this and demonstrate what it takes to get this material out of the ground. And for this to happen, we're going to need $10 a pound minimum as a floor. It's not going to happen below $5 a pound unless there is some miraculously direct lithium extraction breakthrough that taps into the lithium-bearing brines in the oil field. So there is a disconnect between this future reality and the market's lack of interest. But you have to be brave, and until the optics of a declining lithium carbonate price reverse, things are not going to look good. One good thing about this lull is that China is increasingly looking like it's going to annex Taiwan at some point. And how the global West reacts to that, in particular the United States, is very, very unclear. But the car makers, the entire industry, now has a chance over the next few years to solve a major problem, which is the concentration of refining capacity in China. Yes, they're building the gigafactories all over the place, and they've paused the speed with which they are advancing those, but they're still needing the pegmatite concentrates, the spodumene concentrates. They're still going to China. The processing of them into the battery factory inputs, this has to shift into global West jurisdictions. So there's a chance for this to happen. But again, if Trump is the next president, he will do his absolute best to make it reverse energy transition policies and discourage this sort of activity. Now, Patriot is positioned to establish an uptrend later this year after it delivers a updated resource estimate for Corvette and an economics study. Winsom's upside will depend on the outcome of the scoping study it's doing with regard to the Renard Diamond Mine as a processing center for ore trucked from the Adina deposit. Now Winsom has suggested that it might reveal the outcome of this study in Q3 of 2024, but on July 31st, it announced that it has decided to extend the option of making a decision from September 30th to December 30th by making an extra $2 million Canadian payment. So we probably won't hear what's going on with regard to the Renard Mine site scenario until sometime in Q4. Brunswick recently announced a 5,000-meter drill program for Mirage, but it is going to focus on the dikes so far drilled. Now, these are open along strike and down dip, but from the sections that I looked at, they seem to be feathering out in all these directions. So I'm not sure what 5,000 meters is going to accomplish focusing on these dikes. They did report that they completed a till sampling and prospecting program in June and July, and they found some till some spodumene in till on parallel trends to the main 3-kilometer trend of the boulder trend, the Cretaceous boulder trend, whose source has not yet been identified. The pegmatites they have been drilling are different from this huge train, but the till, that what they found in the till likely is a continuation of the existing mirage dikes. So what the market really wants to see is a breakthrough as where on earth does this 3-kilometer train of big spodumene enriched boulders come from. And the drill program doesn't look like it's going to answer that question. And Brunswick has a hideous monthly overhead, and it hasn't raised any money yet. And I do not see this program as generating any new discovery that moves the market. And they will have to finance in the fall. So, and I don't expect a turnaround in the overall lithium sector by then. So the outlook for Brunswick at the moment is grim. Now, Arizona Gold, which is one of my gold explorers, is down 18.2% at 36 cents while it waits for Arizona's heat dome to subside. But there is an interesting development which I will talk about later. Canalaska Uranium, which I talked about in Kaiser Watch episode July 19, after it announced the first long strike intersection for the Pike Zone. It's down 5.4% at 70. There's nothing really new to add other than to wait for a radiometric grade announcement. And this is where this play is different from your typical other metal play. Most plays, you get the core in the box and you look at it, you get excited if your XRF says there's a bunch of copper in it and that, but you have to wait until you get actual chemical assays. Canalaska is one of the few uranium juniors which has the methodology for actually taking the readings reasonably reliable when the core is in the box. So with the Canalaska, you could any day suddenly get a news release where, whoa, now it's extended more than 20 meters. Now it's 50 meters. Now it's down dip 50 meters. So we are watching this very closely, and this is one you want to ride. You just want to hold, because this Pike Zone, which is very enriched, could become a MacArthur clone, and they'll be drilling the rest of the summer. So watch this one carefully. My Copper Explorer Hercules Metals, it's down 25.9% at 60 cents as it struggles with difficult ground conditions at the Hercules Copper Project in Idaho. It reported this week that it has only drilled 4,600 meters using 3 drill rigs in 6 completed holes, 3 abandoned holes, and 3 in-progress holes. The problem seems to be that there are unexpected faults in this area, which means the surrounding ground is very busted up, and when the drill tries to go through it, they run into all sorts of problems. And the fact that they have got 3 rigs drilling and don't have a meaningful number of holes to the target depth where they want to hit this high grade, this enriched copper-silver mineralization, this has bummed out the market, and the stock right now is weak. The company in its press release did say that they are starting to understand the orientation of these faults and are designing drill holes which will avoid the worst rock conditions associated with these faults. And they also claimed in the news release that they are starting to understand where the structures are that result in the copper-silver enrichment that they saw in the discovery hole last year. And that's important because the market has already realized, well, this is not some big Escondida enriched blob, but this is going to be more a system of localized enrichment associated with structures where this enrichment was able to take place. The price of copper, it's threatening to break down through $4 a pound because the Shanghai warehouse stocks continue to climb amid signs that China's economy is growing less than the 5% that they expected to happen for 2024. So the optics of the copper price are not helpful for copper plays, even though an underground block cave copper project would be 10, 15 years down the road anyways before it's developed. PJX Resources is down 10.7% at 25 cents because the market is fretting that British Columbia's forest fires will steal a drilling season delayed by 2 months courtesy of BC's consultation merry-go-round. Now, fires are becoming a very big problem in British Columbia, and there is an out-of-control fire burning about 20 kilometers east of the Dewdney Trail CDEX target, where PJX is currently building drill pads on the mountain slope. Now, PJX was supposed to be drilling by now, but the extra requirement to do a sweep of the drill pad area for endangered species, that ended up delaying it. So the drill pad building crew ended up taking on another job, and they didn't get back here until they had done that job. So these types of logistics requirements colliding with the plotting, consultation, permitting process, none of that is particularly helpful. And then you have these forest fires popping up here and there. Now, this fire is not a threat to the drill program because the fires tend to move up and down valleys, which tend to be north-south oriented here. And this fire is three valleys over. But that doesn't mean a local fire can't get started. And the only good thing about that risk is that the target drilling area, it had a forest fire several years ago, so there isn't as much fuel left for a new fire to burn in that area. But again, it's evacuation order, it's confiscation of expropriation of helicopters and that to fight fires. That's a risk that we have to worry about. Now, I talked to John Keating this week, and he said, they're pretty close to finishing building the pads, and he hopes they'll be drilling this next week. But he's not going to put out a press release announcing that drilling has begun, and he's also not going to put out any visual descriptions of intersections until he has assays. The reason is they are nervous about two things. One, this potential Sullivan II deposit was hidden by this cyanide dike that cross-cuts the face of that stratigraphy, the old layer cake that would host the SEDEX zinc-lead deposit. And while this one is thin, who knows how many more there are inside the mountain. So one of the risks is that when they start drilling where they think the horizon, the exhalative horizon is present, they start encountering all these cyanide dikes. And these are, of course, not going to displace or make the deposit disappear, but it's going to take a while to sort it out. The other thing is, although it looks like it's a layer cake stratigraphy dipping to the east, there is evidence of folding. So until you have several holes into this, you won't understand the fold geometry of this system. So I think it's going to be very quiet in August while they do their drilling. He did say, though, that if they intersect a massive sulfide exhalative style zinc lead mineralization, they will rush the core for assay. And of course, by the time they get that back, they'll have more holes going on. So for the market right now, it's fading because it's unsure. Is drilling ever going to start? Are they going to be successful? It's glass half empty mode. But we have to watch the market because the Cranbrook bars will be paying very close attention to the first Sullivan II hunt in 100 years that actually has a chance of delivering a huge discovery. And as far as my advanced leveraged gold proxy stocks, Westvault Mining and Vista Gold, they're largely unchanged. In the case of Vista Gold, I only introduced it last week, so I suppose I should be happy that it didn't promptly go down. I talked about them extensively in last week's Kaiser Watch episode, July 24th, the Gold Junior Gold Disconnect, and there's nothing for me to add at this point. Gold had dropped below 2,400, but it managed to claw its way back up. So as long as it kind of holds at this level, even though people don't believe it has any staying power here, this is good for these stories.
What is the new development that has positive implications for Arizona gold?
Well, in July 5th Kaiser Watch episode, I talked about how Arizona Gold finally got the BLM permit for two drill pads, which will allow it to test two important goals at its Philadelphia project in Arizona. One is to test the down dip extension of the Philadelphia vein. They've got enough holes in the upper part to do a resource estimate, but they're not going to do one because they really need to understand at what depth of the vein does the gold and silver grade peter out before they put together a resource estimate. And the deeper part cannot be intersected except from drilling from the BLM land to the east. The more important goal is the Red Hill hypothesis. And this is the idea that in the hanging wall of this vein, there is potential for a bulk tonnage system, and they sort of waved their arms suggesting there could be 40 million to 100 million tons of 1.5 gram or better. That's their goal. That would be a 2 to 3 million ounce system. It could be open pit developed. It could be a standalone system. But until they start drilling, they can't do that. And I mentioned in the July 5th episode that the problem is Arizona is in a heat dome. Back then it was 114 to 117 degrees Fahrenheit. I talked to Mike Stark, and he says right now at the property it's 128 degrees. And Greg Hahn is not allowing drilling to begin because it is too dangerous to have a drill crew out there sitting on a rig in temperatures like that. In fact, AccuWeather has reported that in Maricopa County, where Phoenix is located, 27 people out of 423 suspected heat-related deaths have been confirmed as a direct result of heat. So it is an extremely dangerous situation in August. Now, I've seen a chart showing what the average temperature is for the summer months. It does peak in July, but the average is a lot less than what the average has been this year. So August is probably still going to be hot. So I suspect drilling will not resume until September, which means that with regard to these two goals, we probably won't hear anything until November, which is why the stock has sort of slumped and is going nowhere, even though we're in drilling season. Now, the new development that has positive implications for Arizona Gold is the unfortunate development that Elevation Gold Mining Corp on July 30th filed for bankruptcy protection for the heap leach Moss mine. Now, this mine is about 10 kilometers to the south of the Philadelphia project. It was started in 2018. Triple Flag and Greenstone Resources sank about $65 million into it. It's an 8,000 ton per day sort of crushing circuit and piling that onto the heap leach pads. But the grade is 0.4 grams per ton. And that just isn't good enough with the cost structure in the United States. So now that project is in bankruptcy. Now, question is, what happens next? Unless gold goes to $3,000 in real terms or whatever, this project will never be restarted. The creditors are on the hook. It's a care and maintenance liability. It's also a future reclamation liability. Who on earth would want to acquire this project from the creditors? And by the way, it can probably be acquired for pennies on the dollar because there is this ongoing care and maintenance liability. A similar situation applies to the Gold Road project, which is another 10 kilometers farther to the south. Aura Minerals had acquired this project for $1.20 and assumed the non-recourse $35 million liability or debt owed to Pandium, which is a private equity group that specializes in financing small mining companies. They thought that they could do some exploration drilling to feed this little 500 ton per day mill. And this is a milling complex, not a heap leach complex. And they took the gamble, they did the exploration drilling, and they were not able to find sufficient grade ore to continue feeding this mill. So they gave it back to the creditor for $1 and walked away from it. So we have now two mothballed mining operations, one suitable for high-grade ore and the other for a bulk tonnage heap leach operation. Now, this situation changes the dynamics of what Arizona Gold has to accomplish at Philadelphia. Before this bankruptcy, it had to come up with something that was standalone. But now they do not have to come up with something standalone. What if the outcome of the Red Hill hypothesis is that they only end up with, say, 30 million tons of 1 gram per ton, and that which is about 1 million ounce in situ, and given heap leach recoveries of 75% or so 750,000 ounces. So all of a sudden, the creditors or whoever is looking at these assets is taking a much harder look at what Arizona Gold is up to. Obviously, if they prove the big hypothesis, then it's going to be a standalone operation. But if it's the smaller one, basically, with a binary outcome, either it's going to be big or the whole thing is going to be worthless. But now with the Moss Mine available, the scenario emerges where, well, what if we develop an open pit here and move the ore to the Moss Mine infrastructure site? And, doing it by truck probably isn't any good, but the company has been doing internal scoping studies with the feasibility. Let's build a conveyor, an electricity-driven conveyor belt to move the rock, which would save a lot on fuel costs. So they're playing with this right now, and there apparently are tire kickers coming along, signing non-disclosure agreements to look at the fundamentals of this project. And these would be players who might want to acquire the Moss Mine. Now, the other potential outcome is that the entire Red Hill hypothesis is a bust, but the Philadelphia vein does dip down deeper, and they end up coming up with a modest high-grade resource. So this could end up being developed as an underground mine because it would be entirely on patented ground, so it doesn't have to go through the whole BLM permitting process. They could underground mine this ore, truck that down to the Gold Road mill and feed it into that, and wouldn't, of course, make the stock go to the moon, but it would represent some sort of exit strategy. So this Moss Mine, unfortunate bankruptcy event does make the outlook for Arizona Gold more interesting. But again, until we have the drills turning, we just have to wait. Temperatures remain high in Arizona. They will be lower in September, and later this year we should find out if either of these goals of the down dip extension of the high-grade vein or the Red Hill bulk tonnage hypothesis, to what extent these are confirmed.
John, thank you so much for the update.
You're welcome, Jim.
I'm Jim Goddard. We've been speaking with John Kaiser. Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.